This is part 2 of our interview with two PIP board directors, John Burgess and John Singer, in which they discuss the biggest changes in the private equity industry over the last 30 years. Having participated in the industry for so long, you must have seen some big changes over the past 30 years. What are the most important of these? John Burgess.
Well, the changes have been absolutely massive. When I started, it was very much a nascent activity, and PE was a small part of investors' portfolios, and many institutions had no exposure at all. I remember well, we had to explain to potential investors how a management buyout worked. At that time, they were called management buyouts, how it was structured and how it created shareholder value. The whole sector wasn't even called private equity. There was venture capital and there was buyouts, and that was it. Now, the vast majority of the world's leading institutional investors have an allocation to PE, and that allocation has been growing consistently over the years. And also, we're seeing individual investors who have an increasing appetite for private equity, driven by the search for, good returns in what is a very low-yielding investment environment at the moment. So the range of investors looking to invest has expanded hugely, but many, particularly at the smaller end, the smaller investors and the small institutions, are locked out of traditional PE funds, which require high minimum investments, very often in the millions, if not the hundreds of thousands, and are often also by invitation only. Amongst the best funds, you simply can't get in if you haven't been an investor for a number of years. It also takes a very long time to build a diversified portfolio of investments directly in funds, because you commit today and the money is drawn over 3, 4, 5 years. So you actually only build your portfolio in terms of the investments you have over a significant period of time. And for many, the long fund lives and the lack of liquidity is an issue. Once you're in, you can't get out for a long time. So PIP offers a solution to all of these problems and can be seen as an ideal vehicle for the smaller institutions and the retail investors to have it as part of their portfolio. It's liquid, you get your diversification, your exposure immediately. If you want to rebalance, you can do that when you like. And you get into some of the very best funds that you couldn't do directly. Even the big institutions can't get into.
John, that's a really good overview of how the investor base in private equity has changed phenomenally over the last 20 or 30 years. John Singer, what about the private equity manager side of things?
Good question. I mean, to meet those changes in investor expectations, clearly private equity has had to do something as well. And those managers have evolved enormously in my time. I mean, John and I we each, funnily enough, in our own funds, set up the first pan-European private equity funds way back. And if one looks back to the 1970s, the game was quite a bit concerned with multiple arbitrage. And frankly, that's not under one's control, and it no longer works. In the 80s and 90s, the US cavalry arrived in time in the form of US leverage structures, was born. But of course, that's really in the bank's control, especially during bad times. So that wasn't really the solution to providing the returns that those investors were expecting. And now, very clearly, since I suppose the 1990s, managers have really realized that you have to focus on increasing the EBITDA through value creation. There are no shortcuts. It's the only sustainable way to generate sustainable long-term returns. Now that can be done through a whole variety of strategies for growth, which can be both organic or through acquisition. And so the industry has also had to change its views very much on the type of input that it puts into those portfolio companies. So if we take the 4 basics, you've got financial input, always done that, systems, processes, balance sheet restructuring. No massive change there. Strategic input, yes. At the beginning, those who did it they were really working at an overall company level. And it's had to go down into departments such as, for example, now more effective go-to-market strategies. The operational level used to make private equity players extremely uncomfortable. But actually now you realize you can't actually be looking after the strategy of a business without digging deep and helping with the operational side. And that's at all levels of the organization. So an example today would be companies desperately need help on the procurement and supply chain management. And finally, organizational. And that is something which I think we've got better and better and better at, which is enhancing and augmenting those management teams and those boards of directors by recruiting talented people who we very often know and have worked with several times before. And that, of course, you're bringing in known expertise. It's not that unknown chemistry, and they really can add expertise, relevant networks for growth. So it's the change of inputs, both organically and through growth by acquisition, that have shown really the massive change in thinking and doing by that private equity industry to meet John's investors' expectations.
Well, thanks, John. I mean, that brings up a really interesting point about value creation and the sort of wider impact of private equity on society.